Good evening, everybody, and welcome to tonight's Web3 and Crypto Basics Trading Bootcamp that we have been running live as our kind of test pilot of launching our education hub. We started it on the 28th, and we've got a few more weeks left. If you're finding this recording or if you found your way into today's lesson but you haven't been tuning in like a lot of the people that I know that are on the call, and they've been turning up every week and learning, you can go ahead and sign up by scanning that QR code. I've also shared the link in the Zoom chat. It's at the very top. And you can join the Education Hub. All of the recordings are inside there for you. We've partnered with some other communities. I'm not going to go through them too much because we've talked about them in previous lessons, but Evolver, Jana Crypto Queen, All Things Blockchain, and Finsightful, we've all kind of come together collectively on how we're going to help educate more people in the crypto and the Web3 space. And this bootcamp was the first program, and we actually have some future programs that we'll be putting in there in October, and it's just going to continue to grow over time. So please continue to share and invite people to the group, as it will just have more and more content as we build out the platform. So tonight, Renee is going to be taking you, it's week 6. She is going to dive into the Bybit platform and do her thing and teach you about crypto trading, because that's one thing. If you have been following along, I'm not a crypto trader. I teach the basics. I'm a hodler. I'm a dollar cost averager. So I teach all of that. We'll actually be talking about that in the very last lesson. There's different types of way that you can trade and you can invest. But Renee is the one that is going to be taking you through tonight's session. I'm just going to give you a few announcements before we move on. As I mentioned previously, all of our sessions will be recorded. These will then actually eventually be courses, on-demand courses that will be available inside of the platform. So if you're watching this recording and you haven't signed up now, I highly suggest that you go and you get in there, because there'll just be more and more content being put into the platform for you. However, if you're new to this industry, this is going to feel very, very overwhelming at first. We call it the rabbit hole. Go down the crypto. I'm sure even you could go down the AI rabbit hole, but it can be information overload. So just be patient with yourself. It's, I've been in the space since now like late 2017, and it's taken me a long time, and I still don't even feel like I'm an expert in a lot of the different verticals within the crypto and the Web3 space. It is interactive. We do have quizzes. We have learning resources for you. You can ask questions inside of the platform. And the last thing I always like to warn everyone inside of this classroom, inside of our community, and outside there in the digital world is be careful of scammers. It's becoming worse with AI and cybersecurity and this whole digital economy. So really, please educate yourself. We did do a security course. We're actually probably going to be building out a whole short course and going in depth. I just did a 2-day workshop talking about understanding how cyber security measures that you can be put into place. And I want to actually bring in a lot of those learnings and create a whole course on password management, how to use them, what is kind of DMARC, all these different types of things, ways that you can do to protect yourself. So those courses will be coming soon for you. So quick disclaimer. So I was just trying to mute whoever that was. Quick disclaimer, education purposes only, all right? So we are not giving financial advice. We are not telling you to trade. We always want you to do your own research. All of the learning activities that we provide for you, specifically in the Web3 Basics course, they're designed to actually teach you to how to go and learn and do your own research. The activities that Renee has for you is more for you to get in there and practice and do things in your demo account, and she'll kind of go through those with you, and then all the content's always being recorded. So before I pass it over to Renee, and she's going to jump into the lesson because that's what you're all here for, I want to talk about events. So EvolvH3R, we host a series of different events. The next couple of weeks, we've got some guest speakers coming in next week about DAOs and DPINs. We've got Dominique, who's a CEO and co-founder of Hivelo. And then we got Olga coming in at the end, who has been in the industry for a very long time. And she'll be sharing her insights on the right investing mindset and kind of setting yourself up for long-term success. Like maybe we're all here because we want to learn about how we can make some money trading crypto, but really you have to have the right mindset and the strategy. And a lot of the Finsightful's education programs is more around wealth creation, and investing in cryptos is just one vertical of that. So some great guest speakers coming up. ATB, you can go ahead and sign up to the Luma calendar. We've always got events going on online, offline. We'll be at Token 49. And then same with Evolver. We're hosting quite a few events at Token 49. If anyone's going there, please let us know. We'd love to invite you. We'd love for you to attend. We'll also be doing our She Connects event at the Australian Crypto Convention. And that will actually be inside of the crypto convention. So if you're going to the ACC convention, if you're based here in Australia, I know that we have a lot of students global, so you're most likely not going to come all the way across the world to Sydney to go to the Australian Crypto Convention. But if you do, please let us know. All right, we've got a game that you can play and earn some points, and we've got some prizes that we're giving away, and all you have to do is the weekly quizzes. There's a lot of students in there. I know Nick and Dave and Margaret, and I see a lot of students being interactive in the platform, sharing their learnings, commenting. That's ways that you can earn points, and then doing those weekly quizzes. And then we've got some prizes up for grabs. So there is some hard-coded stable coins up for grabs and some VIP merch boxes. For those here that are in Australia and going to attend, we've got some tickets that we can give away to some of the winning students. And then I'm including an EvolvH3R scholarship for when we launch. It most likely won't be till the end of the year, if not at the start of the next year. But that will be a scholarship program for one of our mentorship programs that we will be launching. As always, we highly recommend, if you have been following along on the bootcamp or you're just new, Bybit has a demo area that you can learn and play, and Renee will take you through a little bit more of that. But just a reminder, always please start risk-free, learn the skill sets, put all the things, the practical activities that Renee provides for you. Make sure that you're practicing in your demo account before you go and play in your real account. So I'm going to hand it over to Renee. We're at week 6. These are all the different types of topics and lessons. And as I mentioned, if you are just joining us or you've just found us somehow through some sort of channel, you can log into the group and you can get access to all of the recordings and all of the materials that we've been going over. So Renee, I'm going to stop sharing my screen. I'm going to hand it over to you so that you guys can get into the heart of today's lesson.
Awesome. Yay, guys. How y'all doing? Yeah, it was a big night last night, Martin. Agreed. Let me share my screen. Awesome. So you guys can all see my screen. Thumbs up. Yeah. I don't know why it always makes me blurry. Anyway, ignore my face. Awesome. So let me just make sure. See if this is gonna work. Oh, I love technology. Okay. Okay. I'm screen sharing. Okay, perfect. There it is. Now I can see it. Okay. Thanks so much, guys. Okay, so as usual, I'm going to run through my slides really quick, and then we're actually going to jump straight into the platform, and I'm going to run through the whole process from start to finish, and then go through all of these functionalities directly inside of the exchange, so you can see exactly what's going. Yeah, and of course, any other questions, if I'm going too fast, make sure that you say something, throw it in the chat, ask me to slow down or explain it if I'm going too fast, because there is going to be quite a lot of information. Okay, so basically we're going to go through the entire process start to finish. I'm going to go into futures specifically because that's what we're using in the trading session in my particular trading method. I'm going to do leverage trades. So I'm going to show you how to add your leverage, how to adjust your leverage, do your stop losses, take profits, how to understand your margin, and all your liquidation and risk parameters as well. So here we go. So in particular, I know I've discussed this before, but I in particular trade derivatives, which are called futures. So they're not actually the crypto itself. It's a derivative based on top of the movement of the actual spot token or coin, if you want to call it like that. And basically what this does is it gives you access to leverage. And so what we can do, especially on the Bybit platform, you can trade up to 100x leverage on certain coins, not all coins. You can trade 100x, but and you definitely do not want to trade 100x on most coins because that's actually crazy. Um, but that is basically it gives you access to more capital, but it also does increase your risk when you're trading. So that's why we're going to go through start to finish how to make sure we can navigate through those risks and then make some good trading decisions. Awesome. And so yeah, we're going to talk about longs and shorts. So that's one of the best things about trading this way is that you can trade the market going up and you can trade the market going down. And especially in crypto, when we go through pretty much 2 years of up and 2 years of down, if you don't know how to trade and to use these sort of uh, uh, different sorts of ways of trading, you are missing out on heaps and heaps of profits because we can make just as much money, if not more, and faster when the market goes down than when it goes up. So learning how to trade markets going down is super, super important, especially in crypto. And we're going to talk about position sizing and risk and all that sort of stuff. We've talked about this before. Always, always, always use a stop loss. Basically, the stop loss is the max amount of risk that you're taking per trade. And this will depend on your trading style and your trading plan. And we will go more into developing that sort of stuff in week 8. Take profits. So there's lots of different ways to take profits, how to set your take profits and where to set your take profits. And then you can also do things like stagger your take profits as well. There's another one called One Cancels the Other, which is like, I will show you how to do that in the app because it does it really easily for you. And basically, if your take profit or your stop loss is triggered, it basically just cancels both of them together. Okay. So responsible leverage. I'm laughing because like the reason why people get into crypto is because they're irresponsible and are trading like crazy degens. So we will teach you how to use leverage responsibly. So we do not recommend, especially when you're starting, to not use more than 5x. I use 100x, but I will show you why, and I'll explain the reasons why I use 100x. Because I do it based on my trading plan and my risk percentage. So there's different ways to kind of do this, but for most people when they're starting, really try not to use more than 5x just to kind of until you can navigate your way through it, understand how it works. That's going to mitigate your risk and keep your risk profile small. We're going to go through the fee structures and how they all work because there's two different types of market orders. So you can have a market order or a limit order. And so a market order is basically an instantaneous purchase at the current price. And so this costs more because you want the fastest possible trade entry at that time. So it does cost more to do that buy or sell. Or you can use a limit order, which is called a maker order. And that will actually be cheaper. So I'm going to show you how to do both of those. Especially if you're doing lots of trades, trying to use limit orders is actually going to save you quite a lot of money in the long run if you can use them rather than just using market orders. So there's different fee schedules. So basically, depending on your trading level, like the volume that you're doing, most platforms will give you discounts on your trading fees if you trade more. So that's basically how that works. So the more you trade, the cheaper your fees will become over time. And then in perpetual funding, so in perpetual futures, we actually also have a funding fee. So this is a fee that basically what happens is that if the market is going up, we explained this a little bit the other week, if the market is going up, you will have a positive funding fee. And basically what it means is that if you have a long position, you pay this funding fee and that funding fee will actually go to the short positions. So if you're trading in the same direction as the market, you're paying a fee to the people who are paying the opposite direction of the market. And same thing, if the market's going really strongly down, you'll have a negative funding fee. And when you have a negative funding fee, those fees then go to the longs. So it's basically a way to kind of balance out the market, but it also shows the aggression of the market. So if you have a super high funding fee going up, then we can probably expect some sort of pushback or some sort of long squeeze going up. And so this is something that we look for at that 0.1%, which we showed you the other week. If you go into CoinGlass and have a look at those funding fees, you can see if we get to that level, then we're going to start maybe looking for some sort of manipulation move or some sort of long squeeze, short squeeze, depending on the direction of that move. So that's why it's always really important to keep an eye on your perpetual funding fee. Okay, so we're going to go into the platform. I'm going to show you how to use all these sort of things, what they all mean. So this is what I'm talking about. You've got a limit order and a market order. There is conditional orders, but it's like most times you don't really need to use that sort of stuff. For most people, 90% of the time, you're only ever going to use limit or market orders. And there's a little calculator in there that we can use to show if you want to figure out how your position is. I'm actually going to give you a spreadsheet as well later that shows you how I do my positioning. That should help you to kind of get your head around how to create your position sizing. In risk management, we'll go through the isolated and cross-margin functions. So as we've explained before, isolated is the safest and the preferred method because what it does is it isolates that one trade and whatever happens to that trade just stays with that trade. So the maximum risk you can ever have is just isolated to that trade. If you use cross-margin, you're actually using your entirety of your account. And so if something happens to one position in cross-margin, it can literally liquidate your entire account if you don't have stop losses or if you get liquidated. So the difference is with cross margin, you will have access to more. So you can create bigger position sizes with higher leverage and with different liquidation levels. So with an isolated margin, your liquidation level is going to be very high and very close. So it's definitely, again, always, always, always use stop loss. There's never a situation and that I would ever recommend you do not use a stop loss in crypto. It's just, I've been liquidated too many times. Every trader that you've ever met will tell you that they've all been liquidated because they did not have a stop loss. Again, I love to tell this story. It's painful. I lost about 5 grand in one trade because my entire account on that exchange got liquidated because of a pin bar move one day in like 2022 or whatever it was. My stop loss was 20, I think it was like $20,000 or something stupid happened. And like we had one of those pin bar moves. It went all the way down, hit my stop loss, came all the way back up again. And so I went back to check my account and it was gone. Whole thing was gone. Because I'm like, oh, there's no way that it's going to move that much in a day. Oh, it's never good. Yes, it can. And it does. And so always, 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 even if you think it's ridiculously out of the money or it's just out of the realms of possibility, always use stop loss because anything can happen in crypto and it does. So always use stop loss. But basically what happens with that is that with the isolated position sizing, your liquidation level is going to be much higher because you don't have that flexibility. With a cross margin, your liquidation level, because there's more in the account, will be further down. So that is another reason why you'd use cross margin as opposed to isolated. And then we're also going to run through placing a stop loss, placing this take profits, and then putting on a trailing stop if you should like to use those. Awesome. So let's go and have a look into Bybit. Um, so Nick, yeah, so you can actually keep track of that within Bybit. Like there's actually a part the screen I will show you that will show like your results and where you can see all that sort of stuff. If you want to manually keep track in a spreadsheet, you can do that. There are also lots of different apps now that I think you can use that will actually connect via an API into your account and they'll extract your trades and you can keep them that. But they're like paid services, they're like paid apps so you can get that will journal your results for you. So there's lots of different ways to keep track of those sort of things. But for most people, if you're only doing a couple of trades, like infrequent trades a week, easiest way is just to get a spreadsheet and to keep it that way. And I do have a spreadsheet for that. Awesome. Okay, so let's do this. Let me do this. I'm gonna put you guys up here so I can still see everybody and make sure everybody is in. Perfect. Okay. So thumbs up, you can see my Bybit screen now. Awesome. Yep, perfect. Great. So now we're inside of Bybit. Again, this is my demo account that I use with HyroTrader. I'm going to go through my trades from this week as well, just to kind of show you that later. But for argument's sake, what we're going to do is we're just going to maybe do, let's do Ethereum because I don't have a trade on that right now. And we'll go from start to finish on how to put through our trade. So I'm already long. I'm long, both of my trades are long right now. Difference with Ethereum is that Ethereum's been going up so much, we might actually get a little bit more of a dip with Ethereum, but other than that, it's been kind of been going sideways all week so far. You can kind of see that. This is actually, just doing this quickly. Let's do this analysis. This is actually, this is kind of almost a triangle. So we have uncertainty. And if you see how it's consolidating right within the peak of the triangle, this is probably a good sign that we're going to break out. So for argument's sake, I'm going to say, I think this is going to go long. We could have a look at our other indicators and have a look at that. But just for argument's sake, I decide that I'm going to go long on Ethereum. So what I'm going to do is I'm going to do my max. What did I do? Oh, I've checked. You know what I've done? I've gone into... Actually, this is another good explanation here. There was a really good question. Who was that in the group? Yeah, so that was you, Nick. You're asking about all the different things inside of TradingView when you have all the different endings. I did reply to that just before, but this is actually a good excuse. So what I've actually done here is see how this is ETH USD. So this is actually the inverse perpetual. So this is actually using Ethereum as the collateral, as opposed to what we normally use, which is Tether, which is my preferred one. So I've actually just selected the wrong one. So you've got BTUSD, ETHUSD. This is all inverse perpetual contracts using the underlying asset as the collateral. So what I want to do is I'm going to use Tether because that's what I usually choose. And if you choose USDC, you can use Circle as well. So there's also those different types. So the benefits, again, in a down market, it is advisable to use the stable coins because your underlying collateral is not going to get smaller over time. But in up markets, if you have Bitcoin or Ethereum that you want to use for trading, you would actually make extra money because not only are you making money on the profit and loss of your futures trade, but over time, your collateral is going to keep increasing in value with the market. So this is actually a lot of traders do like to use these trades and use those underlying assets as the collateral. For simplicity, I just use Tether. So we're going to use Tether, and I'm actually going to go here. So we might go into TradingView later and I can show you all the different ones, but if you guys want to check it out, I did do a post just in the group about all the different types of codes that you use within TradingView to find these charts in TradingView because they do all the different feeds. All the feeds are slightly different because they're exchange specific. So all the different exchanges, they're about the same, but they're not all exactly the same. And sometimes there can actually be quite big differences between certain exchanges if something's wrong or if something's going, something weird in the market. And there are a lot of people who do what's called arbitrage trading. And what they will do is that they will literally just trade between different exchanges, tiny fractions of a percent or a cent of those trades with like these lightning trades and like using these smart contracts to kind of do these crazy like algorithmic trading things. And they will do like $1 billion trade for like 0.01 cent arbitrage between two exchanges, because and it's crazy stuff that these guys can do with these computers now. So that's another different style of trading. When you have massive amounts of liquidity and like capital, you can make massive profits with like a cent or like a tenth of a cent change, buying and selling arbitrage between those accounts like that. So it's pretty crazy what they can do. Okay, so we got back here. We're going to go long on ETH. Going to change my leverage to 5%. Because we're being good, I'm going to use isolated. Okay. The other thing that we can do here is we've got our limit and we've got our market. So I'm going to go to limit because we're going to try and use a limit order first. And what we're actually going to do here is this is using Ethereum as the amount. So if you think in ETH, like I want to buy 1 ETH, 2 ETH, you can use that. But for me, it's just easier to use dollar value. So you just go click on that part here, order by value. And what that will do, it'll do to dollar value. Okay, so let's just, for example, say I have a $10,000 account. My max risk that I want to risk is say $500. So what I'm gonna do, so let's do 5 by 10,000 is 50,000. I'm gonna use my calculator here just to try to make it easy. So last price. With that much leverage, because of how big my account is, I can buy 12,000 ETH. That's pretty hectic. But so you can actually adjust this. This will, if you have an actual account, it will do all this based on your account. So you can do this in percentage types. Cool. There's lots of different things you can go in here. I don't ever really use this, but I'm just gonna kind of like have a look around and enter price. Yeah, I like my spreadsheet, so we'll go and use that in week 8, and I'll show you how to do that. But just for simplicity's sake, I'm just gonna buy $10,000. Awesome. Okay, let me just quick check. Investment perpetual means is using your spot assets. Yes, so that's exactly what it means. So instead of using USDT, which is the second part, you use the inverse, which is the front part. So when it's BTC USD, the inverse is the BTC, not the USD. Yeah, exactly. Okay, so isolated margin with 5x. We're going to use 10,000 USDT. Next thing we want to do is click on the TPSL, so our take profit stop loss. So if you haven't already changed this, there's 2 different types here. If you know, like if you've used another calculator somewhere else, you can just put in your take profit and stop loss right here. But if you click basic, it will take you to the advanced, and then you go into your advanced settings. So that's what we want. So we are going long. We want, if you've got another one, you can put it in here, the actual price. But what I want to do is I'm going to do 5%. So 5% is my stop loss. So overall, that's just my trading plan. That's what I want to do. I want to risk 5% of this trade. And if I put in 5%, my risk is there $100. So ROI is that. Confirm. And then basically we're just going to do is click long. Awesome. Yeah. What's there? Did it work? Where is it? Oh, awesome. There it is. Because we used a limit order, it's not going to execute straight away because it's going to wait for that price. And so what we've got here is 4321, which is down here. You can see our limit order, which is here. So we either wait patiently, which it's gonna, looks like it's gonna hit here maybe. Are we going to get the trade? Are we going to get the trade? Here we go. So basically, why we want to use limit orders is because the fees are basically a third of the price. So on Bybit specifically, to make a taker order or to just do a market order, it costs you the 0.55%, like we were discussing a couple of weeks ago. If you do a taker order, it's only 0.2. So it's literally almost a third, like a third of the cost to get those limit orders, especially when the market is moving slowly like this. And most of the time it's going to come back, it's going to retrace slightly. It's worth, if the market's not moving like crazy fast, just to use the limit orders and to just chill. And most of the time it will retrace a little bit as long as you place it pretty close. And you're going to save yourself like 2/3 of the cost of each trade, especially if you're doing larger trades. Those things can add up over time. When I'm doing day trades and things that are really fast, I don't bother using limit because I want to be in and out, in and out, in and out. I don't have time to kind of wait around for these moves, especially when the market's moving really fast. But because we're just kind of chilling here, we're probably going to get hit. If I go down to 1 minute. The thing is, I can also move this up and just adjust it. Am I going to get hit? I'm going to leave that there, but what I'm going to do is, just for argument's sake, to speed it up, we're going to do the market order. So exactly the same thing, isolated 5x, market order, and then I'm going to do my take profit again, 5%, and then I'm going to go long. Now, because that was a market order, it went in straight away. Here's my isolated 5x, 2.3 ETH. Our entry price, which is the price that it got set at, liquidation price. So the liquidation price is the price at which we would get that entire position would get wiped out. So in this case, that's 3,480, which is quite close. So considering how the market moves, so we could theoretically, Ethereum could dump $1,000. Done it before, wouldn't be surprised. It's unlikely. It's very unlikely that it would do that, but in crypto, you just can't ever say never. But let's do this thing where we can actually, once you have that trade in, you can actually adjust the leverage, and I will show you how it adjusts the liquidation price. So if I now go to 50x. So if you have a look down here, I've now got isolated 50x. It's all the same amount here and here, but what happens is that the money that you've used to base the trade has gone down. And so now our liquidation price is 4,200, which is really close. So definitely Ethereum could hit 4,200 today. Like, that is a no-brainer. That's like literally like $150. If you're using 50x leverage, that is your risk that you're taking. So it's like, yeah, now you're only using 10% of the amount of money. You're only risking that amount, but you're also risking getting liquidated at that amount. So that's why it's really, really important if you are being, depending on your trading plan and your trading style and things like that, in crypto, it's not uncommon for to have massive multiple percentage moves in a day. So for most people, you really don't want to be using more than that 5x. It's going to create that safety net of that liquidation level being far enough away that you can get through the volatility of crypto. If you're day trading like I do, that's why I use the really high leverage, because I'm constantly watching my positions, constantly know what's going on. My percentage loss is like 100%. So I'm risking 100% of my capital on each trade because I know that's how volatile crypto can be. And that's the risk profile that I have for my trading style. But for most people, again, just checking, making sure I'm not missing anybody. And it looks like we're going to get hit here too for our other position, which is cool. That's why we really don't want to be using 50x leverage, 100x leverage. So for argument's sake, on Ethereum, you can go up to 100x. Now it actually shows you your liquidation level. Your liquidation level is right here. So could Ethereum come back down to this level right here? It could come back down within minutes, and that whole amount could get liquidated. But again, it's only $100. So this is like where you're going to have your risk and your reward, your risk and your reward. So yeah, sure, there's an extremely high chance that I'm going to lose $100. But if the market goes in my direction, there's a really good return based on that risk. So if you guys can understand that that's the risk and reward that you're having between using these different types of leverage. When we had the 5x leverage, that liquidation level was so far away that we really didn't have to worry about it. So it's just like you can sleep at night, you can go out, you can leave the house, you don't have to worry about it. 50x, you're like, ooh, it's still close, like, there's still a good chance, but you'll probably be okay in the short term. This one you could not move away from the screen because you could get liquidated within minutes of something happening in this market using the 100x leverage. So what also happens here, if you can see our stop loss down here, that's our 5% stop loss based on the original one. Our liquidation level is now above our stop loss. So at all times, what you want to do is make sure that your stop loss is above your liquidation level, and obviously not too close either. If you're using cross margin. So like we've been talking about before, there's certain times in the market when the market moves a lot, you can get what's called slippage. And so if the market all of a sudden crashes for some reason, something happens, like some big fundamental news event happens and the market crashes, if your stop loss is this close to your liquidation level, the stop loss could fail and get slipped down. And what happens is that it will then hit your liquidation level before your stop loss. And so the whole position gets liquidated. So that's why it's really, really important to make sure that your stop loss is not too close to your liquidation level. Because say this one here, if I have my stop loss here, which is just under the VWAP, and I will go, so my stop loss here is $29. So if worse comes to worse, I'm going to lose $29 because that's where I want my stop loss to be in this situation. But what happens is if I hit my liquidation level, I lose the whole $100. So that's like of the original trade, $55. Here we go. So yeah, $100. So this trade right now, it's $100, and because it's isolated, I'm only risking $100. My stop loss, I'm going to risk $29. So max, I'm going to lose $29. And then, but if I hit my liquidation level, I'm going to lose the whole $100. If you understand what I'm saying, does that make sense? So that's the relationship between your stop loss, your liquidation level, and the different levels of leverage that you can have. So if you're having a look here right now, you're getting a really good return because you're using such high leverage. I'm making 30% returns. Like this is why you use such high leverage, but then your risk is really high as well. If that makes sense. Okay. So let's do, I'm just going to leave that there because I will come back to it. We can do exactly the same thing going short. So let's go to Solana. Okay. Let's go to cross. So I'm going to go to cross and I'm going to go to 5x leverage. I'm going to do exactly the same thing. But in reverse. So what we're going to do, we need to make sure that when we go in here, we change this from long to short because they basically put the stops in the opposite direction. So same thing here, short, 5% confirm, and I'm gonna go short. So let's have a look. So that's my stop loss there. So that's my 5% stop loss. That's actually a pretty great position. Like that's the most recent higher point there. So it's actually funny they're all working right now. And I did the market order because that one put it through straight away. So let's have a look at that relationship again. Changing the amounts of leverage, but now we have cross margin. So what I'm going to do is I'm going to go to 100x here. So I've gone to 100x leverage on cross margin. And do you remember how close the liquidation level was on the isolated? Let's go here. Oh, it's disappeared. Why is that? Oh, because it's now using my entire account. And so it's probably, you wouldn't even be able to see it on here. Let's have a look. Yeah, it's so far away. Yeah, it's like $4,000. So because you're now using your whole account, your liquidation level, depending on the size of your account, doesn't really become an issue unless you're like a normal person and you have like just a normal sized account. So not like $200,000 like these fake accounts do. So that shows you the example of how and why you would use cross margin. It's really great if you have a lot of money because it gives you access to more funding with different liquidation levels. Um, and you won't get like margin calls and things like that as much if you have a lot of money in there. But then again, if one gets liquidated, you risk losing your whole account and everything that's in there just from losing one. Because what happens is even if it's not even if it's too much, it just takes the whole thing. It just liquidates the whole account. So even if you, so say you only risk, and so your stop loss went to the liquidation level, um, it just wipes the whole thing. So yeah, it's really, really risky to use cross margin if you have limited funds. It's always, always, always safer. How do you know? It's cross. So cross margin uses your entire account, whatever this amount is, as the collateral. And so you're putting that entire amount at risk by doing that. So that's why you want to make sure you're using isolated. And then again, if you see right here, look at the liquidation now that I'm on 100x leverage. I might actually do this just to see what happens, just like to show you guys. Let's see if we get liquidated. So basically, because we've got isolated 100x, the yellow line is our liquidation point. So if we hit this point, it's going to take that whole $100. So that's the relationship between the liquidation level and the stop loss. If my stop loss is up here, that's no help because I'm going to hit my liquidation point before I hit my stop loss. So that's why when you're trading, you always need to make sure that your stop loss is a good deal between the liquidation point and the price to make sure, again, to save for things like slippage and that sort of stuff. Because you really do not want to risk losing your whole account. Again, but if you are an isolated, you don't risk losing your whole account. You're only ever going to lose that amount. And actually, what I will start doing, if it does keep going up, we'll just keep watching it here for a couple of minutes. I'll get warnings. And so it actually does warn you before, let me move it down here. I don't know if I can do that. I'll have to make the position bigger. I might get liquidated straight away. Yeah. we'll just see how we go for now. But basically that is how the liquidation level and its relationship. I just put a couple of $100 more on there. So now I'm only ever going to risk $300. So even if I do hit this liquidation point, it's going to be just $300. Whereas say if you had $3,000 in your account and you had on cross margin and you hit that liquidation level, for some reason there was some big event and like there was a spike and you didn't have stop loss, it would take the whole $3,000 in your account. Just gone. Like you did, and it's really hard to kind of when the markets are moving really fast. So it hasn't happened a lot this time, but in 2021, 2022, like when the market was going through the peak and the market was going through the crash as it came down, and things like FTX and Celsius and all these different things that were happening, Luna, the market moved so fast that websites crashed. Like Binance went down, Bybit went down, like all the big exchanges, they can literally just crash because there's so many people trying to access the websites all at the same time, is that they literally just stop functioning. And so if you do not have a stop loss in at that point, sometimes you cannot get into the website to put in a stop loss or to even sell. Like even if you're like, oh, market's crashing, I need to go and sell, it has happened in the past. Even big exchanges and the biggest exchanges have all gone down. So it's really, it doesn't happen a lot, but just in these market crash situations, which are unfortunately common in crypto, you could be watching it on the news and like, shit, I don't have a stop loss. Oh, let me sell, sell, sell. Too late, gone, whole account liquidated because you just can't access your account. So this is why it's another reason why it's so important to have your stop losses in before anything all the time, just in case crazy stuff happens, because crazy stuff does happen in crypto. And yeah, there was like I watched like some crazy just like pin bar falls, like just you just watch the charts go down and down and down and down. And it's like you feel like you want to jump in like and start going short or like getting these sort of things, but there were some points where yeah the whole thing would just fall over and you'd freeze and you'd be halfway through a trade and you get locked out and excuse me, yeah, it was pretty hectic. But anything else? Manual TP, just checking your thingies. So down here, if you have a look, so I am that's a really cool thing about Bybit. You go in here to like, it'll really explain. There's like a little tour that you can do when you first start and it'll show you how to use everything. So the minimum requirement is the minimum amount of margin required to open the trade. And if you go over here, see? So you need to have that amount in the account to hold the trade open. So what happens is say you've got, for an example, you've got like $500 in this account and you open this trade for $300. You can't just go in and take the $200 out because their position would just liquidate. Like it won't let you take that out because that's a minimum amount of money you need to have in your account for the trade to be open. Like it's kind of a frozen amount, I guess. Like that's your like a buffer amount if you want to think about it that way. So just because you're not using all of your amount in that trade, you still need to keep a certain amount of money in the account to hold open the trades, if that makes sense. Does that make sense? Yeah. So this is the amount you need to open the trade, and this is the amount you need to keep in the account to keep the trade open, if that makes sense. Sweet. Awesome. Okay. What else we got down here? ETH trade's going up, so ETH's doing good. So maybe I'll go through, this is kind of all these different areas here. So this will show you all your different trades, like your recent trades, your profit and loss. This is also where if you see people when they share stuff, like you can show these little like yay, I made this much in my trade, blah blah blah. Like, that's a good one. 100% trade. Hey, it's really good. So if you want to come in here, you can have a look at these. Assets is like your underlying assets. So it'll be like this amount and all your other stuff. Your trade history can show you like all your different trades, how much you're buying and selling. This is where your fees will show up. So if you're looking to input your fees into your spreadsheets, you can go here. It'll show you. Excuse me. Oh, got a little bit of a cough going on. Dry. Actually, this is really cool. So this is like a funding fee. Because I've been holding these trades for a couple of days now, this is showing the funding fee. And so, trading fees. It's like positive or negative. So you can see like how much I'm getting charged in these trading fees. So this is just because I've been having the trade open for a period of days. This is not, I have not done a trade since, I can't even remember when I opened these trades, like I think I opened them on Sunday or Monday. And I'm just getting all these like funding fees, funding fee, funding fee, funding fee. These are the funding fees from, you can actually find it up here. This is your funding fee here at the top of the screen. So annualized, it's 11% interest, I guess, if you want to say that thing. Longs paying shorts. So previous one, floor cap, history. Yeah, exactly. So because I'm a long, we're paying the shorts because right now the market is positive. Like overall, the sentiment is positive. We have a positive funding fee. So that way we've got the longs paying the shorts. So those funding fees coming out and then that goes towards the short people. So if you're holding an opposition position, you can actually make money even if the market's going in the wrong direction, if that makes sense. So yeah, so that's the funding fee. And then also there used to be a place where it showed you the fee structure. I don't know where it is anymore. But yeah, again, so they're the two different types of fees that you're going to have to deal with. So you get an open and close fee when you open and close your trades, and then you get the funding fee every, I think it's like every 4 hours when you're doing, or 8 hours. Maybe they're 8 hours. Yeah, 8 hours on Bybit. So again, like this is really cool. Once you start getting into the platform and playing around, that's really helpful. Like if you just hover your cursor over different things, it will show you how they all work. So funding fees exchanged every 8 hours. Long positions pay short positions. Short positions hold long positions for those ones. Awesome. I think that's most of the stuff in the platform that's I use regularly. So in the charts, in the slides that I've sent you this week, I have a video that shows you how I do scalping and like how I do my trades on a smaller time frame. So you can check that out using the platform, how I do my different types of order entries and things like that. Is there any other questions? Here we go. So crypto tax. So there's lots of different crypto tax platforms that do taxes. If you're doing most trades, um, things like crypto tax calculator, there's Coinly, there's a bunch of different ones. There's Sila, which is a local product from the guys based in Brisbane. So you basically just input your, you get an API for your account. And then what you do is you can connect that API to the different apps. And then they figure it out all for you. So futures is a little bit different. You've got to do it a slightly different way. So you've got to make sure that you input your crypto and your futures different. But there's lots of different apps now that you can use to kind of do all that sort of stuff. Yeah. Or else you can always just do it like in a spreadsheet and like export it at the end and then just kind of total it all up and it should figure it out for you. Yeah. Yeah, so definitely, and you can download all your trades. So if you go, order history. So yeah, you can like do like all this sort of stuff. It goes up to like years in the past, and you can actually, there's a place where you can export. If you go up to like, it'll be in your account somewhere. There is a part where you can like export all of your trades into like a spreadsheet and then just do it that way as well. Yeah, sweet. Awesome. Oh, sorry guys. Okay, great. I wonder if we're gonna get liquidated here. Let's go. Don't really want to get liquidated, but is there any other questions while we're here, Guy, inside the platform that I can answer for you? Can I do another trade? Actually, no, let me do that real quick. Let's go in how I got into these trades again, just to keep going over the stuff that we're looking for. And then maybe that will be liquidated when we come back. Let's have a look. Actually. Cool. So we are back into Bitcoin. Okay, here. Let's have a look. Oh. So this is my Artemis Asia range box. So we're going into my trading style next week, which is basically a Asia range trading style. And so what we do is we create this Asia range box based on 11, if you're in Australia, it's 11 a.m. to 11 p.m. And basically we have a look at the different, how the price moves during Asia, basically. And this was actually a really great example of an Asia range break. So I'm going to do replay to here. So let's do here. So, 5 minutes. So Asia is usually to here, which is 2 o'clock. Actually, 3. It's from 11 to 3, actually. There. And so this is the Asia range. I don't know why it's not coming, my indicator's not up. This is not on there. There we go. Oh, it's not set up properly. So this is, if you guys have the paid versions of TradingView, this is the one that I use to get my Asia zones, but the times are all off because it's been set up to the wrong things. I don't know why. That's better. So it's called ICT kill zone, and this is the one that shows the Asia, the London in this particular graphic. I like this just because it works with my boxes really good. And so we have from 11 a.m. to 3 p.m. That's our Asia range. That's how we do our top and our bottom of the range. And so what we're looking for is how it moves after the high and the low have been completed. And so what we've got here, I usually draw this line based on the trend. And so at this point, we're looking to have a downtrend. But do you see what happens here? We have a really small break of the low of the day. And we have all of these manipulation candles. So what have we learned is like whenever we get these manipulation candles, something's going on. So when you see this sort of thing, we've got a really slow break of the low. This is my sign that we're probably going to get a bounce. All of these big candles pushing through, they're pushing through the 50, like all of these sort of things. Maybe what's not even on there. Cool. You up? Okay. Oh, it was there. There we go. So again, so what have we got? We've got a W formation, we've got manipulation candles, we're breaking the 50, we're breaking the VWAP. This is going to be, for me, a signal to go long. And so I actually ended up going long over here once it had this retest. And then we got this really great big push up. Here we go. Boom. This was an area we were looking at. This is one of our vector candle recovery zones. It kind of like hit it and then pushed out, but then it pushed straight through. So you can kind of see here, it's consolidating in this area. Let's just go. Here we go. Yeah, perfect. And that's where we are now. So these are the sort of things that we're looking for. The other thing is that this was on Monday. So like we've talked about before, I've called it the false move week beginning. And so you'll usually get a move in the opposite direction on Monday or Tuesday to the direction that it's actually going to go. And so what we've got here is we have this fake move down on Monday and then we go straight up. So these are the sort of things that you want to be looking for when you're trading in this method. Trading using the Asia range, we had Asia fake out, down, and then we have up all week. So we are in Wednesday right now. So this is usually halfway through the week, and usually what we'll see halfway through the week is a reversal. So either tonight or tomorrow, we might see some sort of M formation around here. This is another area of interest here. Let's have a look over here. This is a previous old one. This is my area of interest that's the longer term one. This is like the big long term one. I don't know if we'll get back up here. I think that we're closer to probably doing something down here. So maybe we come up and then we go down here first and then we come back up. So that's kind of where I'm thinking right now. If this fails, this area fails, we're probably going to see down here first before we go back up. But we could see. There's a lot of theories about, there's something called the quad witching this month, which is basically all the traditional market futures and options all expire on the same day, which is like the middle of September. So in the cycle of things, that could be actually the low, like the short-term low for now. So if we come down here and just kind of like form some sort of reversal pattern down here, this could be a really good buying opportunity. Again, not financial advice, but keep an eye out at this 100K level. We could get some really interesting stuff happening at this 100K level for sure. Awesome. Do I take profits manually? Yes, I take my profits manually. We can go back into Bybit to show you that, but it's literally like that's the way you can do it. Actually, there's two different ways. Let me actually do that. Okay. So, okay, so let's go back to our ETH. So there's a couple of different ways that you can set your take profits. Actually, so what I can do, if you go into, so this is your take profit stop loss. Once you've already got it open, there's a couple of different things you can do. I can add my take profit. So say I want my take profit to be 50%. I can put in a take profit at 50%. Yeah, that's new. Oh, we're on 100x. Okay, so this is my take profit, and notice how it says all. So that's going to completely take the whole trade. And this is this OCO order, because once this one hits, it will cancel the stop loss as well. The entire trade will close. The other thing you can do in here is you can do partial positions as well. So say if you just want to sell 50% at, what did I say, 75%. It will then sell half of your position there. And so as you go up, you can have this position, this position, this position, going all the way up at your set prices. And these are all market orders. So whenever you use that functionality in the stop loss and take profit, these are market orders. So they're going to get done instantaneously, but they're also going to charge you the full price fee. So you can get around that by using limit orders. So say we wanted to do, if you want to set a limit, and say we wanted to do, I'm going to get rid of this, rid of that, cancel. So say I want to sell my limit order here, it's a 43.60. So let's sell 5,000, because our whole position. Okay, so this is our $10,000 position. I'm going to sell 5,000 at 4,360. So click short, and that's going to create a limit order at that price. And so what it's going to do, it's going to sell that position, that fraction of your pot. For the complete amount, I would still always use the stop loss, the take profit feature. If you're not always watching it, sometimes it's not perfect and sometimes it can leave stuff running and that sort of thing. So if you want to do the whole position, let's just do 150. There you go. And that's going to be guaranteed to close the entire thing at that price, and there's no chance of it messing up. This way you're going to get cheaper fees selling it here. If you use nice round numbers, if you were using like Ethereum, you could play around with doing like 1 Ethereum, 2 Ethereum, nice round numbers. But I've had issues before with like the math not being perfect because I'm like spaz. So I would recommend doing it this way. If you want to have limit orders set up as your take profits over time, and then just make sure that your final position is that stop loss level 1, which is it's the OCO. It will completely close your stop loss, it'll close your take profit, it'll close the entire position, and you know that it's safe at market order depending on what happens. So having them as kind of the sandwich between your other ones, you can do it that way. And that keeps it safer. And that way you will get cheaper fees by using these limit orders. So it looks like we're going to get hit. Hopefully that'll be good. Just kind of show you. The other thing we can do is do a trailing stop. So got my Ethereum here. Now, if we go over here, down the bottom, there's your trailing stop. So you can use distance, you can use a percentage. So if you want to use dollar value, like have it trailing like by $100, or you want to do it by like say 5%, which is kind of our blanket rule that we've been using. So you can also add the activation price, which means it needs to kind of, if you're not watching the market, you can have an activation price. So say you want Ethereum, if Ethereum gets to $4,400, I want them to set this trailing stop, because now you're going to be in so much profit that you want to be able to keep that profit as you keep going up. So we can do that. So once we hit $44,000, $4,400, sorry, this trailing stop will then kick in, because say like right now our stop loss is, it's not in profit yet. But if you're not watching the market and the market all of a sudden runs away, this can kick in for you to create that safety net, that it will kick in and keep your profit going, I guess. Because what can happen is overnight, you're in massive amounts of profit and then the market turns and you're asleep, which often happens when we're in Australia, things like that. This way, it will move your stop loss as the price goes up while you're asleep. And if the market does turn and come down, you're going to lock in that profit. Whereas if you just kept it in at normal profit stop loss, it could go all the way up and all the way back down by the time you're even awake. And you've missed out on that whole opportunity of that profit overnight. So having a stop loss, a trailing stop like this, is a really good way to add protection for, especially if you're not watching the market 24/7, or if the market's being really volatile, and especially things in overnight, because so many things happen overnight in America when we're asleep. So adding that stop loss, that trailing stop, you're going to add extra layers of profit potential that you might have missed otherwise. Yeah. So basically, all technical analysis works on every time frame. It is basically, oh, did we just get profits? Yay, look, we took profit. And then if we go to trade history, so see here now that order type limit. So this is our limit order. So look at my trading fee is like $1, as opposed to all my other trading fees that we've been doing is like $5. So, I mean, it is only half of it, but that is showing you the differential of like the limit order to the market order on how much fees you're saving by using the limit order. If we hit this too, it's going to actually show you, it'll show you the difference between the two fee structures between both of them, which is actually really cool. What was I saying? Yeah, so trading, yes. So basically all analysis works the same way. You will see the same shapes, the same movements of the indicators will all be different over the different times, like the same. So you can use it, but you would use uh, different amounts of money, different leverage levels and things like that, depending on your trading plans. So if you don't have a lot of time, um, trading longer term is good because you don't have to watch the market as much. But in general, you need to either use higher leverage or bigger amounts of money to make more money. But higher leverage doesn't really work if you're not watching the markets because it's so much riskier. So if you have access to uh, larger amounts of money, you can use less leverage and create the same amount of returns. Usually, if you have less money, you want to increase your leverage a little bit, but you're going to increase your risk and you're going to have closer stop losses and things like that to mitigate that risk. So, if that makes sense. But yeah, the shapes and the patterns and all the sort of stuff is the same. So say for me, like I use the 1 hour, the 15, and the 5 minute, and the 1 minute for entries. You might use the 1 week, the 1 day, and the 4 hour charts in the same, looking at the exact same relationships to the time frames. But your stops and things like your would have to be bigger because the movement over those periods of time is going to be a lot bigger, if that makes sense. Does that make sense, guys? Awesome. But yeah, that's really interesting, guys. It's really fun having a look at these. I might actually get this take profit here. How's our Solana trade? Oh no, our Solana trade's not doing good. We're gonna get, oh, we might get liquidated. Let's get liquidated. Woo! Oh, oh, oh. Might just look, are we gonna get liquidated? Let me see if it if it gives us the warning. Because what it should do is give us a warning that it's about to get liquidated. Let me see, am I getting any warnings yet? But yeah, what was the profit for that trade? Where do we see that? Okay, we're gonna get liquidated. Yeah, look. See, yeah. Your soul. So we did just get liquidated on that trade, but we only lost that $100 or whatever that was. So there's no risk to like the rest. I still got $200,000 left in this account. So that is why it's so important to make sure that you're using isolated in these sort of things. We go here. Woohoo! Everything's going gangbusters. Holy. Okay, so this is our realized P&L here. So if we go to trade history, it will show us that information there. Cool. So liquidation was triggered and then the total price was a little bit more. Cool. If that makes sense. Field type liquidation, we got trade heaps of fees for that because it was liquidated the whole account. So you got extra fees on top of that. Yeah, that's really, really cool. And then P&L. So if you go to P&L, it'll show you the actual profit and loss for each thing. So the trade here is the $37. We made the profit for that trade. That one was a complete wipeout of that entire position. Is it order history? This one's the fees. Yeah, so this is the one that you want to use to kind of figure out what your fees are. And then the P&L is where the actual profit is for each of the things. Does that make sense? Cool. But if we're in the positions here, the realized profit here is the profit minus the fees. So this account, so before it said that it was like $37 P&L. So see how it says $37.99? That was the profit from that trade. But then if you go into your actual position, that is after fees. So your realized P&L is your P&L minus the fees. So this is the one that you want to keep track of. This is the unrealized. So that is like what profit we're currently in for the middle of this trade. Cool. That makes sense? Yeah, so this is the one where we had the limit order for the partial take profit. So I did a 50% limit order for here. So that was the one where I came up here. I can do another one. So say I've got $5,000 left here. So what I can do is I've got $2,500 limit order. And say I'm going to do my limit order here. So like so let's do 4,375. 4,375. So limit order 4,375 for 2,500 short. And what that's going to do is put that limit order in. And so using the limit order, we're using the cheaper fees because there's the limit and market orders. Using the limit order is cheaper fees. That's why we like to use that for these sort of things. When it's not really important that we get the market execution, like in a stop loss, that's why I would never recommend using a limit order for a stop loss because it can get missed. But for things taking profits, using these limit orders, you're going to save yourself more in fees using them that way. Cool. Yeah, realized profits. Cool. Because we have sold some of those. These ones I haven't sold any of them yet because we're still going up. But that shows you on these large amounts that's how much fees that you're paying for the trade. So this trade is $3,500. I've paid like $300 in fees for one way. So that's not even like when you sell. So that's why with these bigger amounts, you get charged fees based on the amount of the total amount of the trade, regardless of the leverage. That also is something to take consideration. So say if you use 5x leverage, you don't get cheaper fees than if you're using 100x leverage because the fees are charged on the total amount. So if you do $10,000 trade, that's 1 by 10,000, or if you use 10 by 1,000, or if you use 100x by 100, they all equal 10,000. You pay the fees on the whole amount, regardless of the amount of leverage. That's also something to take into consideration. So yeah, so whether you're 1x leverage or 100x, same amount of fees, or it's on the total amount of the trade. Cool. Awesome. And that's another thing, like here, if you wanted to move these limit orders, you can move them and amending them and things like that. So you can basically chase them around if you want to be, so let's do that, something like that. You can just adjust them on your screen, which is another cool feature. If you want to save those fees, I'm probably going to get hit now too. Move it down like this, something like this. So this is why you kind of see the way that it's moving. If I was doing this live and I was trading my short term, I could save money by following it around like this. But if all of a sudden the market keeps moving in the opposite direction, I'm going to lose a lot. I'm going to lose more money by not executing at the price that I want than I would get by saving in those fees, if you know what I mean. So that's why in general, shorter term, faster trades using market buys and sells is just easier and faster and more efficient than using these limit orders. But on bigger time frames, bigger amounts over longer periods of time, yeah, use limit orders and you'll definitely save yourself more money. Awesome. Okay, guys, it's 8:30, so hopefully that wasn't like too overwhelming. And if there's no other questions, we'll save them up for next week because we'll go over the full Artemis method from start to finish, how to draw those boxes, how to trade using the Asia session, looking for different formations inside of the Asia session, and how we use that my particular trading method. So yeah, awesome. Thanks so much, guys. And of course, we'll follow up with all the stuff. Let me just quickly see if there's anything else on my slides. My slides. There we go. So yeah, so next week is going to be all about my trading session. And then yeah, all the rest of the stuff. Here's your homework. Do your practical challenge. Do your demo trading. Show us your stop loss and take profits. And then yeah, we've got our quiz. Do practicals. And then there's some further learning. And this is the video that I was talking about how I do some more demo trading of like how I do my short-term scalp trading inside of Bybit. So yeah, thanks so much, guys. And we will see you next week.